Hi everyone, and welcome to this video that I have entitled, Is This a Risk-Free Trade? Of course, this is a cash flow option spread series video, and what I want to do today is I just want to talk about a recent trade that I took that showed a risk-free trade, and in fact, there are a lot of things that you can do to make this as close to a risk-free trade as you possibly can. It's one of the best trades that you'll see as far as a probability is concerned. But before I just jump into that trade, I do want to make sure that everybody understands that when I talk about this, it's received in the context that it's given, that there are risks in trading, and this video is for informational purposes only. So when I talk about this, and I will give a lot of context to this trade, but I want to make sure that there's no misunderstanding here, that I'm not saying that there are not a set of circumstances that could create risk. In fact, I'll show you a set of circumstances that could create risk in this, and I'll also show you how to have a very, very, very high probability of avoiding those circumstances. So with that being said, I'm just going to jump right into the trade because it is a very interesting scenario. First of all, this is a diagonal option spread in SPY. And I was filled at a credit of O2, and I was filled at a credit of O2 on a rather large lot size, actually several trades. And this specific one, rather large lot size, credit of 2. And what you're looking at is a projection graph of this trade as of expiration. And you'll notice here that since I have a credit of 2 cents, that means that there's no risk to the downside, and based on the structure of the trade, it also means that there's no risk to the upside. This is, of course, a call spread. If you have a credit of 2 in a call spread, you're guaranteed to make at least $2 if the market tanks. If the market increases, if the market skyrockets, the way that I have the trade structured, there's also a minimum $2 gain there as well. And in between, what you'll see is a wide profit zone. And that profit zone ranges anywhere from about $100 to a peak of around $400 and maybe $350. And then in between, obviously, there is a bit of a sag in that between, let's see, 405 and 410. There's a bit of a sag there, right? But notice how much room there is for a $100 profit. The zone for a $100 profit is pretty high. And I'm going to reference that here in a minute because what you're going to see and what you're going to realize is that what this risk projection is telling us is not what is actually going to happen. And that's where people get into trouble with these risk graphs because there are other things going on. So what happens is there's a projection, there's a calculation that is made that is projecting the value of the long options as of the expiration date of the short options. And it's a projection, they're guessing. And they're guessing with a mathematical calculation. And that mathematical calculation doesn't take into account a lot of different things. And so what I look for in these types of trades is room for error. Room for error. So this is a $100 profit zone here. And obviously that you don't see any risk anywhere on the graph. That's because there is no projected risk on the graph. And you'll also see that this is the trade that I took. Originally, I took a 100 lot on this particular trade, and then I exited partial of that lot size with profit. So you can see here a closed profit of $3,200, an open profit of $4,410. And that one is basically based on where the market is, where you can see there, it's kind of at the profit peak, but we're not anywhere near the expiration. And so you don't see that kind of profit in that expiration just yet. But again, the net profit between the open and the closed is $4,400. And a lot of people see this trade, and obviously the first thing you're going to ask is this trade too good to be true? And the answer to that question is yes and no. In one aspect, it is too good to be true, and in another aspect, it is not too good to be true. And I'm going to tell you right now that I will take this trade every single time it's available. Now, again, this is a projected graph. And so if you understand how the options work, which I've been doing this for a long time, 1987, I took my first option trade. And I've taken hundreds and hundreds of these trades that you see. So I know how these work, not from theory, from actual taking of the trades. And so the one thing that I want to make sure that you understand is that you can understand certain things about this projected graph. A, it is a projection, and B, that projection cannot be wrong in certain areas. So for example, if the market tanks, I am guaranteed $2. This projection cannot be wrong in that. The projection cannot be wrong if the market moves to the upside. If it skyrockets past all these profit peaks, I will make $2 on this trade, given that you're filled, right? Otherwise, you would just simply let the thing expire, and it would come out to $2. Of course, you would have to pay the fees and all that. So you understand that when I say $2, I mean outside of fees, or outside of assignment fees if you end up getting assigned and just let it assign itself out. But nonetheless, that's the way the math works. But if you understand how the projection graphs work and how the calculations work, then you understand that there's an issue here. And that issue is what I call the dead zone. It's a sagging area of the profit zone in between two of the profit peaks. Okay, so I've highlighted it in pink. That's where the risk is. And the reason that there's risk there is because at one point by expiration, or before the end of expiration, the value of the long options in this spread could be wrong. The ending projected value could be wrong, and that's going to drop that dead zone, potentially. It could either raise the dead zone or it could drop the dead zone. But on the outside, right, on the outside of this, if the market moves down, then the worst thing that can happen is everything expires worthless and I make $2. On the upside, the worst thing that can happen is all of the extrinsic value goes away from the long options, at which point I make $2. Okay, so that's how the math works. But in between, we don't know exactly how much these long options are going to be worth. So we have to understand how they work and what other factors go into creating these projected values. And so here is what you actually might experience. And in fact, this is what was experienced on one of the trades if it was held until the expiration date. And if the market dropped into this dead zone, you can see that where it was projecting a profit, it's actually projecting a very, very small loss. So if this was the end of it, if I showed you nothing else, this trade would still be worth it, because there are two significant profit zones here, and the risk zone in between is very, very small. It's a very small risk zone, and it's a very small potential loss. And there's no risk to the downside, and there's no risk to the upside. So that being said, this is as of the day of expiration. Okay, it's very crucial that you understand this, because there is more to this trade. So if the market closes in the middle of the dead zone on the day of expiration, then you might suffer some risk there. So that's where the risk is on the trade. But you know what? You know how these work? Take a look at the day before expiration. There's the dead zone area. Do you see a dead zone there? And this is fairly realistic. So the day before is actually more realistic than the day of. And I've adjusted the volatility to reflect a drop in volatility, which would ultimately drop the price of the long options. Nonetheless, but you can see the day before, there's a nice profit zone at 60 bucks, and there is no risk zone. It's like it's disappeared, or it doesn't actually materialize until the last day. Now, sometimes I've seen these materialize, or excuse me, 1 day or 2 days before the expiration. But I know, I know when those are going to happen for the most part as well. It's certain types of trades that can happen. On this one, most likely not going to happen on Thursday. But here's 2 days before the trade. You'll notice that the projected profit is actually a little bit higher 2 days before the trade expires. And again, you'll notice the dead zone area. Not only is there no sag, there's no dead zone, you actually have a pretty decent profit sitting there at about 60 bucks, 40, 50, $60 somewhere in here. And a nice profit zone here. Profit peaks out at about 100 bucks. So that's 2 days before. Now what I'm going to show you is I'm going to show you something from my Trade Partner. Trade Partner is a trading platform that I created, and I use it to help me analyze the risks and the actual realistic expectations of any option spread. And so here's what I'm going to show you. Column 1 is the ending value of this spread, the exact spread that I placed, the exact spread that I've been showing you, on expiration. Okay, now the blue arrow are the strikes that I've taken. And everything above and below is the same exact spreads, only you're shifting the strikes by 1 point. So, for example, if you had a credit spread of 400 on the short side and a long of 405, and that comes at a credit of 3. Well, what's the price of the credit 401, 406? What's the price of the 402, 407s? What's the price of the 403, 408s? Right, so it's the same credit spread, just on a different place as far as the strikes are concerned. So this is the same thing. So this is the peak, what you see here, the peak of the profit projection. And you'll notice the value of that's $244. Now, if I were to get into a trade at a $2 credit and it ends at a $2.44 debit, then I make $246 on this trade. But if the market moves up, then that profit starts to go away until eventually it goes to just $2. If the market moves down, eventually that profit goes away until it hits the dead zone. So you can see the dead zone here, right? So in other words, if the market moves down into the dead zone on expiration, down into the dead zone on expiration, that's where you see a small credit. So if I get in to this trade at a 2-cent credit and it closes, or I get out at a 9-cent credit, then obviously I lose $7, right? So that's where the risk is. And these are actual prices, so I'm giving you the actual results of all of the spreads, or the projections of all of the spreads based on where it is relative to the market. Now look at column 2. Column 2 is 1 week before expiration. And you'll notice that there is no dead zone in column 2. And that's because this dead zone doesn't really materialize. It might start materializing the day before, but it really doesn't materialize until the day of in this particular spread. And so what this means is that as long as you get out before expiration, you have a very, very, very high probability of success. So you'll notice here, there's a 73-cent debit, 57. So this is the trade that I'm actually in. I'm in at a credit of 2, and it's at a 57-cent debit. Now, if the market moves down, then I'm going to start giving some of that profit away. You can see here it's a 23-cent debit, but that's still a profit. It's a small one, but it's a profit. If the market moves up, it holds on to the profit a little bit more. You can see a 73 debit here. You can come up here to 72 debit. It's going to average out up here, but that's because this is the graph. Whoops, that's not the graph. Well, I'll get to the graph. That's 1 week. Nonetheless, you can see the actual prices here, right? So that's the one I'm in. That's the one I have a $4,410 open position profit because I took a partial profit early. And why did I take a partial profit early because I know that the market can move back down or move back up out of this profit peak zone, right? And so might as well take a nice profit on the trade and then hold on for maybe a little bit more on the rest of it. So I exited 80 and I have 20 left. And here is the graph 1 week before expiration. And you can see here the profit peak. There's a nice little leveling out at about $50. It can actually go up to about $60. And it's sitting at 57. So this is very, very accurate with what we see. In fact, it's a little bit muted because we saw a $73 debit in there, right? So that's a $75 profit. So the actual profit in one of these in the profit peak up here is a little bit bigger than what this graph is showing. So again, no dead zone. And look, if the market moves down, you've still got about a $10, $15, $20 profit. Even if it moves down significantly, if it moves up significantly, it's going to hold on to its value a little bit better, and I'll explain that. Well, I'm not going to explain that in this video. It just will. So there's ample opportunity to exit this trade before it ever reaches that risk zone materializes. So if you hold until expiration, there is risk. Or if you hold too long, there is going to be risk. I'm not going to put an absolute time frame on it. It might be, a few hours before expiration. I've seen the day of expiration, and this trade is fine. I've seen similar trades where you start to get into that dead zone a little bit the day before, maybe in the afternoon. But before that, there's plenty of time to exit at a profit. So if you hold on until expiration, there absolutely is risk with this trade. If you get out early, the probability of consistently making money on this trade is greater than any opportunity I have ever seen. And that says something. Now, again, there are caveats to that. There are circumstances where this exact trade could produce a risk before a day before. And mainly that would happen if the market starts consistently moving up and the overall volatility begins to drop. Then you might see this trade doesn't look as good, but there are things that you can do to account for that. And I'm not going to get into all of that. Nonetheless, I did want to show you this trade and show you how you can create just an astronomical probability. I can't say risk-free, but it's as close as you will ever get in a single trade or a single opportunity. So now, of course, that's assuming you get a credit on the trade. I will take this trade even if I can't get a credit. Sometimes it might be a $5 debit, sometimes it might be a $10 debit. I'll still take the trade because prior to expiration, I have a very high probability of making something. It's not going to be a lot, but it's going to be something. And if you understand the compounding, this is a tremendous opportunity that can be compounded. So sometimes the credit is not available. Sometimes it is a debit. So for example, here's a similar trade that's filled at a debit. And I did something slightly different with this trade. And this is an actual fill to create that debit, but I did it so that it would beef up the dead zone. So I actually have even a lower probability of that risk zone emerging in this particular trade because of a slight adjustment that I made to how the trade was structured. So it's a $16 debit, which means that I have $16 risk to the downside and $16 risk to the upside. And by the time we get to expiration, obviously this whole profit zone is going to come down a little bit, but you don't see a sag in this dead zone, right? It's the slope is fairly consistent to the upside. So the probability of that actually dropping below zero is, even on expiration day, is almost nothing. And so I could do that by taking the risk and putting it on the outside, right? Either to the downside or to the upside. So that just kind of gives you an idea of how I approach these trades. And you might be asking yourself, where can I get access to these kinds of trades? And the simple answer is you want to sign up for the Cash Flow Trilogy Daily Signals. You're going to see opportunities like this every single day. Well, not exactly like this. I have specific types of opportunities that I post in these signals. What I do is I give you 3 trades a day. At the end of the day, there's no market watching. You either put the order in or you don't. Either it gets filled or it doesn't. But you'll get 3 trades a day, 1 neutral, 1 bullish, 1 bearish leaning. 1 neutral, 1 bearish leaning, 1 bullish leaning, all with mathematical probabilities that are fixed in your favor. And you're not going to take all 3 trades a day. You only need 1 or 2 per week. In fact, if all you were to take is that trade alone, you don't need anything more than that trade. So you can watch out for that trade. So with these signals, I also post the projection graph so you can see what it looks like. I talk about the dead zone, if there is any dead zone. I try and keep away from dead zones with these signals, just so that you don't have to be concerned about it or as concerned about it. Every now and again, I'll post one that has a dead zone, but you don't need to take 3 a week or 3 a day. You only need to take 1 or 2 a week, and then you are able to compound your account very efficiently and create geometric growth. Now, you're also going to get, with that, you're going to get 4 instructional videos on how to properly execute the trades and what the realistic expectations are for each of the trades, or the trades in general, I should say, and how this all works, how the projection graph works. I kind of explained it here, but you'll get more instructional videos along those lines. Plus, you'll get a trading plan, an exact trading plan that you can follow. It's a template, but you can follow it with these signals. That includes the money management, the compounding, and instructions on how to execute those. Plus, I'm going to give you a bonus on this specific trade. I'm going to give you what to look for, when, and how to take advantage of it every week. There's a very specific time that you can get into this trade, potentially at a credit. Not always, but at a credit, and it doesn't last very long. So I'm going to tell you exactly the trade, and I'm going to tell you exactly when to look for that credit and place that order. And hopefully you'll get filled as you move forward. And I'm going to tell you exactly what to do if the market starts to tick up consistently, how to change the structure ever so slightly to further eliminate the risk of that dead zone. So you're going to get all of that, and it's very affordable. I made it to where anybody can subscribe to this, and there's nothing else like it out there. So you can either go ahead and sign up, click on the button on the website, or you can call Spring at 918-203-7547. Tell her you watched this video. She'll get you signed up, and she'll get you taken care of. So I hope you've enjoyed this video, and I look forward to see you on the calls.